is Wasco a good value opportunity? That's what we will investigate together in this video. Hi, I'm a French investor diving in the ASEAN stock market. If you like my content, please subscribe to the channel. Let's go for this analysis. What is this company doing? They are in the business of pipe coating, pipe manufacturing, and corrosion protection solutions. So you can understand that they are operating in the global oil and gas industry. They are really upstream because they are depending on capital expenditures from companies trying to export, transport oil and gas. But the good thing is they are trying to be less cyclical by developing a segment for renewable energy. So good thing, we have for now a company which is a bit cyclical, but they are moving structurally to be less and less cyclical. Good thing. They are listed on the Malaysian stock market. The stock is listed in Malaysian ringgit. Let's go for the analysis in Koifin, the software I use for stock analysis. If you want to subscribe, you can do with the comment in description. Okay, let's go. The stock price went from 67.67 Malaysian ringgit in the last 10 years up to 1.05 Malaysian ringgit. The performance is not impressive. Stock market, the market cap is 813 million Malaysian ringgit. So it's a small cap. Let's have a look at revenue growth. We have a median revenue growth of -3%. Over the last 12 months, we have a -18%, but be careful here. We have divestment. The scope changed for this company. So it looks like they are degrowing, but it's not the case. They have a small organic growth, and like the industry, which is mature. The oil and gas industry is of course mature, but they are trying to diversify with renewable energies. So don't expect to have much growth for this company. I think you can expect to have mid-single digit or maybe low double digit, and it's fine in my opinion. Now let's have a look at margins. And here it's good. We can see that the margins are increasing. We were at 14% in 2016. Now the gross margin is at 16.2%. That's cool. And the EBITDA margin improved way more. We were at 6.4 in 2016, and now the company has an EBITDA margin of 11.4. Great operational improvement. That's impressive. The net income margin is at 6.2%, and it was negative at the beginning of this decade. So the company reached its profitability threshold level. So it's good news for the shareholder, of course. And we have a bit of free cash flow generation. This company is still a small company trying to grow and to improve margin. And so they need to reinvest quite a lot to grow. And that's why we have from time to time free cash flow below net income. It's not an issue because the company is still a growing company. Even if the industry, the market is mature, it means that this company is taking market share, and it's good for the margins, of course. Let's have a look at net income conversion into free cash flow. We have cumulated net income of -442 million ringgit. Well, not great, but we have free cash flow over the last 10 years. It's 2.8 billion Malaysian ringgit. So I think this company actually is profitable if you look at cash flow instead of the net income. The net working capital is positive. Most of the time it's because positive net working capital is because the company is a small company and it cannot have the payment delays it wants for the suppliers and for the clients. So unfortunately, it means positive net working capital. And when you have a positive net working capital, it means you have to use liquidities or debt to finance the operations. It's the case for this company. If we look at the level of revenue, it's 2.6 billion ringgit in the December 25 for the whole year, and the net working capital is maybe at 15%, something like that. So it's still manageable. The threshold, the risky level would be 25% and above. But here, I think it's safe. No worries with the net working capital. Let's have a look at the change in net working capital. Over the last 10 years, it's minus 1.1 billion ringgit. That's great. So it means the company over time is able to improve its net working capital position. So if it continues like this, at some stage, there will be net working capital. They will have a negative net working capital or nil net working capital, which is great, I think, for this kind of company. Let's have a look at CapEx against D&A. We have more CapEx than depreciations and amortizations. It's because the company is still investing to enlarge its fixed asset base for future growth. And it's a good sign for me because it means they are seeing growth opportunities. So good news. I have to add that this company is a global company. They are operating outside of Malaysia also. So it's good to invest and to expand globally. And that's what this company is doing. We have 3 billion ringgits other than cash items. I don't know what's inside that. You need to go to the cash flow statements to understand what's inside this other than cash items category. So with all these elements, we have way more free cash flow than diluted net income. So if you want to value the equity of this company, it's better to use a price over free cash flow multiple than a price over earnings multiple. Let's have a look at profitability in terms of return on invested capital. We have a median value of 6.3%. I think until 2022, this company was actively destroying value. How do you measure value creation? It's simple. You have to take the return on invested capital, subtract the weighted average cost of capital, and if the spread is positive, then the company is creating value. What is the weighted average cost of capital of this company? This company is in a cyclical business. It's operating in an emerging market also, but also it has subsidiaries in developed markets. So I think the weighted average cost of capital for this company might be something like 8 or 9%. We can see that currently the ROIC is at 11.5%. It means that this company is creating value for the shareholder because it's above the weighted average cost of capital. Good news. Good news. With profitability, it's a pretty intensive business, and even with this capital intensivity, we have a good profitability. It means that the management was able to increase the margin, but we already saw that. The EBIT margin increased a bit over time. Yes, it's the case. The other way to improve the profitability is also to increase the asset turnover or decrease the fixed asset base. It's the same thing. So profitability is fine for Wasco. Great news. Let's have a look at net debt. It's below 1 times EBITDA. Well below 1 times EBITDA. It's almost 0.5. So no debt, no big debt to be worried about. So great news regarding free cash flow. It's 2 times free cash flow. So the net debt is perfectly manageable for this company. Let's have a look at shareholder returns. We have dividends. We have 39 million ringgit dividend against 84 million ringgit free cash flow. So this dividend is perfectly safe. It's less than half the free cash flow. Good news. We don't have share buybacks. I think Asian companies, except big companies, but they are not doing much share buybacks, and it's the case here for Wasco. They are returning cash to the shareholder only with dividends, and with this dividend we have a 4.8% dividend yield. which is good, and it's perfectly safe if you compare to the free cash flow table. So great, yeah, great stuff. Let's have a look at valuation now. We have a median EV over EBITDA multiple for the last 12 months at 6. Currently, it's 3.6 times. So we have a big discount compared to the median value. Do we have a discount on price over tangible book value? Yes, we have 10% discount on this multiple. It means the value of the company is less than the theoretical value of all its tangible assets. Of course, you have to investigate what are these tangible assets, what might be the market value of these assets, but here, at least you have a small discount. So on these two metrics, Wasco looks undervalued. To conclude, I think it's a small cap, so be careful with this kind of stock. It's a bit risky. It might be a bit volatile. This company is operating in an emerging market, which is Malaysia. It's listed in Malaysia. It's operating in Malaysia, but also they are operating in other markets like Canada, where I think it's less risky. And it's also cyclical because it depends on capex from oil and gas companies, but they are trying to diversify with renewable energies. So with that, maybe the risk is decreasing. And in finance, you have two ways to improve your return: increase cash flow or decrease risk. And I think they are doing both. So it might be an interesting stock to dig into. I hope you found this video useful. If it's the case, subscribe to the channel, and I see you in the next one. Bye bye.